Good afternoon, ladies and gentlemen. We would like to present our hold recommendation for Thomson Reuters with a target price of $43.30, representing an upside of 9% to what it was currently trading at yesterday. Our analysis indicates the company enjoys a leading market position in the majority of the segments they operate in. However, they continue to face intensifying competition. Their cost-cutting program is on track, and they continue to return value back to shareholders. And we incorporated all of these factors into our valuation to come up with our ultimate target price. We note that the investment risk underlying the stock continues to limit the attractiveness of the stock upside. Moving on, with what began as the acquisition of Reuters by Thomson back in 2008 is now a multi-billion-dollar company, providing products and workflow solutions to a variety of markets. Of importance to note is that the majority of revenues and EBITDA are derived primarily from the financial and risk and legal segment, as well as the Americas region. In 2011, the company went through an executive turnover, primarily due to Eikon not delivering many of the benefits that were promised, and primarily also due to the influence of the Thomson family, which is the majority shareholder of the company. At the very same time, the simplification program, as well as the transformation program, were introduced. Looking further into the financial and risk segment, which accounts for more than half of the revenues of the company, the majority of revenues are, it is the only segment in which the majority of revenues are derived outside of the Americas. And as you can see at the top of the graph, the EBITDA margins are not as competitive as its peers. However, with the introduction of the cost savings program, we expect the EBITDA margin to be much more competitive going forward. In the industry, we see that data spending is increasing in all geographic areas, however at a slower and slower rate, primarily due to investment banks continuing to face increased regulations, as well as limiting the potential for revenue growth, and so they are focusing more on cost cutting, as evidenced by the lower and lower headcounts year over year. Moving on, in the competitive landscape, we see that Eikon continues to lose market share to Bloomberg, but remains #1 or #2 in all geographic areas. The recent Bloomberg scandal has caused financial institutions to reconsider the security of the chat functions of Bloomberg, which is a major selling point of the terminal. We believe that they are demanding for more open source chat functions that allows users to communicate with any terminal that has this sort of software. We believe that with this development, in addition to the cost-cutting measures implemented by banks, this will be very beneficial for Eikon, which has a very competitive pricing structure in comparison to Bloomberg, and we expect them to take back some of the market share that was stolen away from them. Although this development is too early to realize, we do see hints of this, as net sales have been positive for 3 quarters in a row, the first time in 6 years. With increasing regulation, we also see the demand for risk solutions products to increase, and this will definitely benefit Thomson Reuters Excelis, which is one of the leading risk solutions products out there in the market. Furthermore, expanding further into the restructuring, the simplification program deals more with the reduction in headcount in the financial and risk segment, as well as the consolidation of a few legacy products, whereas the transformation program extends beyond that and continues to consolidate major legacy products, consolidating data centers as well as data networks. We looked primarily into the revenues per employee metric and saw that after the simplification program, they were much more competitive with industry peers, indicating confidence that management does know what they are doing with their restructuring efforts. Now I'd like to pass it off to Oliver, who will talk more about the other 3 segments.
Thanks, David. Legal is the second largest segment, providing online and print research, as well as legal solution software. And in doing so, they have been achieving EBITDA margins that are above its peers. Now, even though the demand for legal services has been stagnating, firms are shifting towards better efficiently managing their firm practices in order to drive profitability. In addition, there has been a steady increase in headcount within legal firms, thus driving the demand for online legal research. Which leads us to our first catalyst, which is Westlaw's next reputation as a de facto standard for legal research software, due to its widespread usage in both academia and research. In addition, corporations are experiencing increasing budgets for their legal spending, and as a result, this is driving the demand for legal process outsourcing software, such as Serengeti and Pangea 3. And moving on to the tax and accounting segment, this segment provides integrated tax and accounting compliance information as well as software solutions. So as firms are looking to become more global in today's society, accounting and taxation rules are becoming more complex, and as a result, firms are seeing increasing value in taxation and accounting software. And this leads to our catalyst for this segment, which is Thomson Reuters' entrenched market position, driving continued and consistent growth going forward. And onto the last segment, the IP and Science segment. Not only does this segment focus on information, but also decision support tools that allows companies to continue to innovate. And so some major tailwinds we see in this sector include increase in global R&D spend, patent applications, as well as the increasing prevalence of the US e-commerce industry. And this ties into the catalyst for this segment, which is the Mark Monitor product, which is a form of brand protection software, which has been gaining significant traction due to the increasing popularity of online shopping brands. I will now pass it over to June, who will be discussing the valuation.
In our DCF model, as we can see that there are not a lot of significant changes in other segments. But in our F&R segments, we are expecting the EBITDA margin to increase significantly due to the cost-saving program. Ultimately, we expect the overall EBITDA margin to increase, as well as the free cash flow to grow at a sustainable rate. At a perpetual growth rate of 2% and an equity multiple of 10.5, we arrive at our target price of 44 to 45.50. Based on our sensitivity analysis, we can see that there are a lot of upside potential for Thomson Reuters if they are able to execute their strategic plans. We also took analysis to see if Woolbridge's majority ownership will bring holdings discount. But according to the fact that there's no multi-class structure in Thomson Reuters, we believe that the holding discount is not warranted. We also conducted a comparables analysis. At first, we only look at the industry peers, and we feel like our target price is overvalued because they're operating under different parts of the industry and they have different growth. So then we look into different segments, and we try to identify the direct competitors within each, which allow us to arrive at a target price of 42.70. As you can see from our valuation for Waterloo, the current price of 39.75 is undervalued under many valuation methods. In addition, Thomson Reuters is dedicated to returning value back to its shareholders through its constant growth in dividend payouts. And we believe that it will be sustained in the future because based on their financial payout ratio. Additionally, the company has indicated that it's going to purchase up to 90 million shares, constituting a 3.8 billion share repurchase program. And now I'm going to pass it off to Jeffrey for investment risks.
There are many investment risks that we need to consider in our projections. The first one being strategic risks. Currently, Thomson Reuters is implementing a cost simplification as well as integrating the remaining legacy products into Eikon. The risk posed here is that there will be cost overruns, delay in the schedule, as well as a reduction in the retention of customers. The second risk that is posed is that Woolbridge is a majority shareholder and that they can exercise any significant influence on management policies. The third risk that we have to think about is that information is becoming more free and accessible due to companies and regulations. As a result, we may have potential entrants entering and competing with Thomson Reuters products. However, this risk is mitigated due to the fact that information requires time to be compiled and interpreted, thus increasing barriers to entry. The next financial risk that we considered is that Thomson Reuters has implemented a policy of share repurchases and dividends. They must generate enough free cash flows to meet this management objective. However, when conducting our debt stress test, as well as seeing from historical performance, we see this risk as minimal. The last risk that we've identified is that the demand for Thomson Services products depends on the underlying health of the industries that they're in. Earlier, we've established that the headcount for these industries is actually declining. However, we've seen a slight increase in the demand for these services. Furthermore, we conducted a scenario analysis to incorporate our assumptions to account for a worsening economic and competitive environment. Under increased likelihood and significance of all our risks, we established a worst-case target price of $31. In conclusion, Thomson Reuters has a leading market position and has intensified competition within the industries it's in. It has demonstrated effective cost-cutting programs, but there is still uncertainty in the future as to whether they'll meet these targets, as well as their undervaluation leads us to reiterate our hold recommendation at $43.30. Thank you. We would now like to open the floor for any questions.
Could you go back to your methodology on valuation? What exactly did you do to come up with the 43.40?
So in deriving our target price of 43.30, we looked at both the DCF model as well as the comps, and as well as the precedents, but we decided not to use the precedents due to an overinflation as well. So for the DCF, we concluded with the EV/EBITDA multiple of 10.5 times, arriving at a target price of $44. And in our sum of parts comparables, we ended up with a 42.70 target price, and combining and weighting them equally, we arrived at our $43.30 target price.
Sorry, did you say that you did conduct some relative ratio analysis with others in the industry, or not?
Yeah, so we did look at to see whether or not the companies were comparable, to determine if they were an excellent comparables to the company.
So we rated these companies in terms of comparability with their growth profile, their market cap, as well as their profitability. And we've done this through Harvey Wells. And from our analysis, we determined that some of them are quite comparable, but we do have a majority of these very comparable within each of the 4 segments. So for example, within the financial risk, we have FactSet, McGraw-Hill, and Morningstar that were quite comparable. And we leveraged this into our comparables analysis.
Okay, thank you.
Just quickly back to your DCF model, where how far out you guys forecast? Because if I remember correctly, where one of the sensitivity slide saying the terminal growth rate changed from 1.5 to 2% to 2.5%, the valuation changed so dramatically. So how can you be sure what will be the right terminal rate to use?
So I believe, so as you can see right there, our terminal, we forecasted it out for 5 years. And so the major, so because the perpetual growth method had such a wide sensitivity, we decided to use the exit multiple approach. And then from using the exit multiple approach, we determined whether this multiple was appropriate by implying a perpetuity growth rate using the 10.5 times. So as you can see, with the 10.5 times EBITDA exit multiple, you get an implied perpetuity growth rate of 1.84%, which we reasoned was in line with sort of the future growth potential of the company that we see.
And we also chose that forecast period because from management guidance, they're implementing simplification and transformation programs that last around that 5-year forecast period. So we tried to model that into our projections.
Okay.
Did you take into account changing technologies in your revenue sensitivity and your modeling?
So one thing that we looked at with our bear case scenario was the lack of revenue growth due to other competitors coming into the industry and stealing away market share. So in our very bear case scenario, we projected little to no revenue growth in almost all the segments, and from that we arrived at our share price floor of $31. So we have taken that into account into our bear case scenario.
You mentioned Woodbridge as a potential risk. Could you talk about that a little bit more, just given that obviously Woodbridge and the Thomson family has been a majority investor for as long as the company's existed?
So historically, Woodbridge has been kind of like a voice within the Thomson Reuters company. Even leading up towards the merger, it was kind of like a brainchild of the CEO as well as the Thomson family. Going into 2011, the Woodbridge company was also another factor with the management turnaround, especially leading towards a change in the CEO.
And so one of the major risks that we see associated with Woodbridge, to elaborate as what we mentioned earlier, is, for example, if management were to propose a plan, like a more extreme plan for cost-cutting measures, Woodbridge can definitely, they do have members on the board of directors. So if the plan was put in front of the board and the board did not like it, they can definitely have significant influence over even the operations of the company. So that's one of the major things that we considered when looking at Woodbridge. However, we have seen that in the past, they have been acting in line with the shareholders. So they're also dedicated to return value to shareholders. And so we see that won't have that significant of an impact going forward.
An important part of your thesis is increasing share of the market. Did you guys get a chance to test Eikon at all versus Bloomberg versus some of the others?
Some of us have used Eikon.
So yeah, I've used 4 of the products. So I've used Eikon, FactSet, Capital IQ, as well as Bloomberg. And so the main differentiating factor that I saw with Eikon versus Bloomberg is the fact that you get to customize a lot of your screens. So especially like with FX trading and fixed income trading, there are a lot of screens that you can that you're able to customize and have consolidate a lot of the information on a home screen. Whereas in Bloomberg, you're constantly finding yourself clicking one screen in order to get to another piece of information, and then clicking that link to get somewhere else. So it's a lot harder to navigate. And Eikon has also been stressing the interface aspect of its program. So definitely helping out in terms of usability for new users that aren't used to very complex, the complex sort of algorithms that Bloomberg uses.
What was your assumption in terms of how much market share Eikon was going to be able to, because historically they've actually been losing market share to Bloomberg, and so what is your assumption built into how much market share they'd need to grab in order to get to your numbers?
In terms of market share, we've seen it in the past 6 quarters that they have increased their net sales. However, from what we've seen historically, they're still trailing quite a lot in terms of the market share with Bloomberg. Currently right now, there's kind of a lagging safety effect with the switching costs. We don't expect any dramatic increase in market share. They'll be rather much gradual.
And we would see a decrease in share price if the net sales positive trend gains momentum, and therefore we can further integrate it into our model. But for now, we don't see the valuation hasn't really incorporated the market share recapture going forward.
I noticed that you presented some information about holders of the equity, both the Woodbridge family, institutional and retail. Did you also look at it from a geographic perspective, where the majority of shareholders were located by country?
We do have the list of the top 5 owners.
So after Woodbridge has majority of the other ones are mostly Canadian and American institutionals. So I believe Royal Bank was among them, as well as ING, RBC, Franklin, which is amongst North American funds. So there is no, I guess, diversity within the geographic distribution.
You think the stock will be up by 9%? Is that kind of your estimate based on your stock forecast? And what do you presume the market's going to do over the same period?
So looking at just overall S&P TSX, especially in the information technology sector that we focus on, the Thomson Reuters has been outperforming that market. So we do see it outperforming in the next couple of months. However, one of the major things that we're very uncertain about is how the cost-cutting measures are going to be implemented and how successful they will be. And that's why the uncertainty that plays into the cost-cutting measures is what's really hampering our valuation going forward.